Very good to be speaking with you, Your Excellency.
Thank you.
Your first live speaking engagement since you took on the role, so it's really good to be talking to you. So given this is your first sit down with us in a televised format, I just want to start with your vision for the fund. Walk us through what you are planning for QIA and potentially how it differs from what it was doing in the past, if not at all.
First of all, thank you for having me, and I'd like to share some of the views on QIA. So first of all, we're very proud of what we do. We believe it is really investing for good. The vision of QIA is to accumulate and grow the net worth for the fund, so ultimately be able to add and contribute back to the state and future generations. It's a very noble goal to start with. Also, it's a very big ship. So as we steer the ship, it makes a lot of sense from time to time to revise and think about what you're doing and how to improve it, especially when you think of markets that are very complex and environments that are ever-changing. I wouldn't say really we have major movements or strategic movements for the fund. I think we have a very strong fund, and I've been in it for 15 years. But I think with time, we're increasing our pace when it comes to specializations, which areas, which priorities to focus on, and how do we invest in human talent internally. So we have the best human talent and the best strategic and agility to be able to continue to become an outperformer in markets that are quite complex to navigate through.
Last week, you made the announcement that QIA are looking to invest $500 billion in the US over the next decade. So quick back-of-the-envelope math, that's about $50 billion a year if you just divide by 10. Before I ask you about what those investment opportunities are, how does that figure actually compare to what QIA was investing in the US in prior years?
It increases the pace for sure. So I think some years probably increases by double, and some years probably by more than double what we've been doing for the past 5 or 6 years. As you know, His Highness indicated openly that a lot of the additional reserves sales that's coming from the LNG expansion will be routed to the Future Generations Fund. And since you're a beneficiary of that guidance, it's very important for us to think organically, how do we grow? And US is 60% of the available trading markets in the world. So it makes sense that most of it will go to the US market. We also believe in the robustness of the US systems, the growth perspective that the US enjoys. So we'll continue being there, but it's definitely a major uplift. So part of the key mandates that we have now in QIA is how do we prepare ourselves and systems to be able to grow systematically, significantly in size, both in terms of people, but more importantly in terms of how to continue to be and thrive to become a very excellent investor in those markets.
Yeah. On that note,
but it's a major uplift for sure.
It is,
and it's a huge amount of quantum of capital. What our evaluation now is that how do you position ourselves, how to become efficient investors, and what areas and themes to focus on.
Yeah, I'm going to ask you about that. Let me just bring up the poll results because we asked the audience to get involved with this. So, will U.S. exceptions in trade make a comeback this year? Only 54% of people say yes. The rest say no. So not everyone is as optimistic on a relative basis as some of the other people that we've spoken to in the room. Let me ask you from QIA's perspective, and of course you have a more long-term view on the U.S., obviously. Where are the areas that you want to get involved in the U.S.? What are the biggest themes you're interested in right now?
There are themes, I would kind of classify them as it's a very general question, but if I make it a little bit narrower and think about the U.S. and major industries within the U.S., they tie in global themes as well. So one of the key themes we're spending a lot of time on is digitalizations in areas that add value. So as you think of digitalization, and AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in? Digital investors becoming more and more digital or AI-enabled, that actually adds value to economic growth. And this, we think, could be time, because you have a strong hardware power and you have a strong software power, as we see, and it's accelerating significantly. But a very important, another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies. And we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses. A second very important area, which is also U.S. is a big part of it, given the current policies that administration is pushing for, is how do we think of the world from a globalization to deglobalization or fragmented economies. Mm-hmm. And if you look into the data over the past 20, 30 years, this has already been happening. So to share some stats, the U.S. amount of trades with China was about, so U.S. amount of trade with China was about 20%, 22%, if you think of 2018 or so. This year it's around 13%. So it's a major reduction of the amount of trading relationships and capital on goods between China and the U.S. And if you look at from different perspectives, so if you ask and say, what is emerging markets doing with each other, you'll notice a significant increase in amount of trades. Yeah. So another important element to the U.S. is how do we take advantage and position ourselves on the areas of supply chain reconfigurations in light of also what's happening with the U.S. around trades and encouraging establishing trades. Also, if you look into the data in the U.S., I cannot recollect exact years, but I think probably toward the late 90s or mid-90s, 30% of the U.S. GDP was attributed to industrial activities, while now it's around 10% or so. Yeah. So the U.S., in addition to supply chain configuration and trades, logistics and ports and things of that sort of infrastructure, you also may have a need for further industrialization within the U.S. in a world that will become a little bit more kind of globalized. The third area, which is not really a theme, but I think there is a lot of things changing on the correlations and underlying risks and of various parts of the markets. So as you've seen, there is significant reduction in terms of a high level of volatility and significant reduction at some points between the correlation relationship between equities and bonds, for example. Mm-hmm. In a world where there is more also, again, a trade and related and things of that sort, you expect to see more foreign currency volatility, more interest rate volatility. So the third one, I would say, more tactical. So one is around digitalization and technology. I think it's a key aspect across industries. The second one around supply chain in a new world. The third one is around how do you become tactically aware and agile when it comes to your portfolio and asset management policies.
Well, let me ask you about your tactical allocation. And are you reducing exposure to any asset class?
We are thinking hard in terms of underlying risks. So the interest rate environment was much higher the past few years. Now we're thinking is how much should we allocate to fixed income, for example. Interesting. Right? In a world where there is a lot of challenges, you may end up investing in businesses that are not necessarily fixed income or credit related, but they have similar attributes and could offer you more growth. So to answer your question tactically, I think we're revising very deeply how much we should have in fixed income as a conservative asset class. And we're thinking very deep also some of the traditional asset classes that we have, whether we need to increase or decrease some of those asset classes as well, like infrastructure and real estate.
Let me ask you a question about your AUM, because His Excellency earlier in the morning talked about the fact that new inflows are going to be coming in. What is your expectation for how big the fund is going to be by 2030?
We haven't run the final model, I'll be very honest with you.
Roughly?
We haven't run a model, okay. Honestly. I don't really have the exact number. Also, it will be bad because I may say a number and then underperform as a fund and not meet it. Because it would have to come from two factors. First, investing wisely to outperform and get there, and then the inflows. So I don't want to hold myself accountable for underperformance.
Okay, but assuming that the fund continues to grow in size, which I think is a fair assumption, we don't have to pin down a number, is that going to change the way you invest? Because you will have to invest for opportunities that can give you scale? Definitely.
So QIA performance has been strong, and we expect with some of the things we're doing internally for it even to be stronger. We strengthen it through specializations and focusing on the right areas and constantly revising and thinking about our asset allocation policy. But as the fund size grow in size, this will push us to have even longer duration on the portfolio. So we can take longer term bets and themes and industries and specific technologies or other businesses and take advantage of the liquidity premium to underperform. So I don't expect major change in the style, but I think it will be more refined and will focus on areas to take advantage more of our ability to have a larger fund and also think of longer duration.
Fair to say perhaps a bigger emphasis on direct investments then in the future?
That is Qatar, you mean?
Yes.
I mean, we have a good emphasis on direct investments. A lot of the partners we have been and think of globalization. A lot of them think about supply chain solutions, decentralizing industries. So from our mandates, it's our responsibility to pass them along and be the kind of holding the hand and try and introduce them to the domestic stakeholders to encourage them to think of Qatar as a destination. And starting as an investor is also good because they've seen when we promise, we stick to our words and we stood beside our partners in good time and difficult times. So it resonates when they think that you're inviting them to have business in Doha.
Yeah. More and more funds have been looking into opportunities in private credit, and maybe I should link that back to what you were saying about fixed income and finding opportunities between public and private. In that space, do you think it has become more challenging to find decent investment opportunities simply because so many funds have an interest in those assets?
It's definitely a crowded market compared to 7 or 8 years ago. We started in scale in the United States, I would say 6, 7 years ago, when we thought it was an interesting time. COVID enabled us also to do more. It's becoming a very crowded market, I would say. And the other problem with private credit is you may underwrite a private credit thinking it's actually a credit piece, but when issues come by, you realize it's more underwriting. So our strategy when it comes to private credit is to focus on managers and to go with scale, and many times actually be on pilot seat. So we have kind of an SMA accounts with a lot of the managers we have, so we can put the dial, which is more risk or less risk. I'm very proud of the team we have also within QIA doing that.
Yeah. Earlier on, you were talking about one of the thematics, and that is digitalization, artificial intelligence. Interesting that when President Trump was in the region last week, many partnerships and deals were announced. And I wonder whether that's also an avenue for QIA to be involved too, in terms of securing and working with US companies for the advancements of AI technology in the region and in Qatar, obviously.
Yeah. We're investing a lot in the US, extensively. So we started investing in data centers and some of them in AI, in hyperscale space about 10 years ago. So when we started originally, we were hesitant really about the asset class. When we developed familiarity after a couple of years, we did deploy in size. I'll tell you, we're very happy with what we've done early because those things are very valuable now. Because when you do things early, you have the ability to negotiate better terms. So you've have access to a lot of assets in the US. Overall, we've invested and have exposure to about 5 gigawatts as a QIA. And we've done it systematically with discipline. When it comes to AI, which is the applications on top, we've also been active, both in the hardware, both in the infrastructure software. So we've invested this year a significant ticket, 500 million in Databricks. And also we've been active on the application size. We've been hesitant to come the application size of things for a while, but have been quite active this year as things materialize. We also invested significantly on XAI. We thought they have a superb focus on a fully integrated system and solution. So we've been active from last year, and we also redeployed again with them this year. So we've been active. In the US, we also have a good track record. I think one of the things with the Mr. President Trump policies is encouraging, as a lot of people trying to encourage investors to come to the United States. And I think they came to the realization that capital coming from an entity like QIA or Qatar is a very welcomed capital because it's quite commercially driven and speaks to the same values.